You know, I would say something about taxes. That's all I know about is taxes, so I'm going to give this to you. The gain on the sale of a residence, so if you bought one, you know, you buy your first and you've lived in it for 5 years, 10 years, whatever, and you want to move up to the next one. You want to move up to something bigger, nicer, and so on. You can sell your first home and you receive a $250,000 exclusion from the gain on sale from tax. As you can imagine, the gain on sale is going to be taxable, but that first $250,000 is exempt. If you're a married couple and you've been there and you meet the qualifications, the $250,000 doubles to $500,000. So what are the qualifications? Well, for 2 years of the 5 years previous to the sale of the home, if one of you owns it for that 2 year period, and both of you have lived in the home as your personal residence for 2 years out of the previous 5, and you have not taken this deduction, this exclusion, in the last 2 years, this is the current rules, then congratulations, you get this exclusion. It's a very, very valuable exclusion. It's worth probably, $60,000 or so to you, if not more. And you can do this every 2 years. Every 2 years you can move from one to another like this. Fortunately, Congress right now is in the process of changing the rule, and they would like to lengthen those periods so that you'd have to live in the house for 5 years out of 8, and that this exclusion would happen only every 5 years. So perhaps they will get that through, and perhaps not, but it's still otherwise a very, very a good deal for you to remember as you're doing this. One of the things that comes out of that is that if you are, once you have reached that, as a couple, once you've reached that $500,000 gain, what you should be thinking about? You should be thinking about buying the next one. That's the point when you should start thinking about buying the next one, because you've got your first $500,000 free, but after that, you're going to start paying capital gains tax on the further growth in value of that home. Your home's growing. Somebody else's home, the one that you want, perhaps the next one, is also growing at the same time. So you want to try to eliminate the tax drag if at all possible. So as you reach that $500,000 gain mark, that should be a wake-up call to you to say, do we stay or do we move? Do we want to move up, move out, take our gain, do something else with it? Property taxes in California. So you might as well get this today, because it's a very, very, property taxes, very expensive business, but here are the rules. So let's say that we buy a home today for $1 million. Imagine us drawing a line with a slope of 2% per year. Okay, this little dotted line here. This is the maximum amount of property tax. It starts at 1%, which would be $10,000, 1% of the value of your purchase. In other words, the actual sale price sets this 1%. In addition to that 1% for the basic property tax, school districts, all kinds of other districts and so on can pass bond issues and other assessments that add to your property tax bill. So instead of 1% of the $1 million valuation, it might be 1.1 or 1.2 or something like that. But the important thing is this valuation number, this $1 million number. And as I said, it can only grow for you. It can only grow at 2% per year, no more. So what happens if the value drops below the line, the actual value of the house, for whatever reason? We've had a bad market, whatever, the stock market crashes and all sorts of things happen and real estate goes down to here. Well, if the assessor is proactive, they will automatically reduce your bill to reflect this value. But they don't have to. And so in cases of down markets, you should be aware of how much your property is worth and ring up the assessor and say, you know, I'd like to get a review of this because I think it's lower than it otherwise is. So let's suppose that happens. Your property goes down in value 15% temporarily, and then the next year, you know, something great happens in your community and the price rockets back up again. You are not, the 2% only deals with this line. It doesn't deal with this. So you could theoretically move from here to here in your assessed value from one year to the next, but never higher than this dotted line. Okay, so this, although coming into the market gives you a sense of horror as you look at this and say, oh my God, the property taxes here are terrible. After a little while, you know, when the market grows, you too will be taking advantage of this lower than market valuation at some point in time. Now, if you are if you're fortunate enough to inherit a home from your parents, you get to keep their valuation. Your valuation does not change, does not go up. If you are 55 years old, there's another little trick in here that allows you to move down, price yourself down. So suppose your assessed valuation is $1.5 million at that point, and the property is worth $3 million. And you see a property that you'd like to buy that's worth $2 million. You want to buy a $2 million property. Under the regular rules, you would have to pay on this assessed valuation. But under a special rule, it says as long as you're trading down, you can take your valuation with you. The old valuation can come with you as long as it's in county or in a county that will accept that valuation. So, property taxes.